This presentation is for Chapter 13, Stockholders Equity, and now we are going to cover Learning Objective 3, which is accounting for the purchase and sale of Treasury stock. So first of all, let's talk about what Treasury stock is. So Treasury stock is the corporation's own stock that it had previously issued and later reacquired. So this is like stock that they've sold and then they go out in the market and they buy their own stock back. So you may wonder, why would a corporation want to buy back their own stock? Well, there's lots of different reasons for doing it. One reason may be that the corporation's management thinks that their stock is undervalued or the price is low, so they could buy their own stock and later on they could sell it at a higher price and they would make money off of that. Another reason that they do it sometimes is just to support their own stock. So if they are out in the market actively buying their own stock, that supports that stock price, the price that they're buying it at. So that can be one reason. Another reason that they do it sometimes is they're trying to avoid a hostile takeover. So when we talked about that each share of stock has one vote, so if someone is trying to do a takeover of a corporation, they're going to sometimes go out in the market and buy those shares of stocks of the corporation until they have over a 50% share, and then they get to elect the board of directors, and basically they are running the corporation. Now, if management wants to prevent that, one way to do it is to go out in the market and buy back a lot of the outstanding shares so that they're not available for a person to get that controlling interest. And then the last reason is that many corporations have stock option plans. So for their executives and some of their top employees, they'll reward them with stock in addition to their pay. So you have to have shares of stock on hand to allow those employees to exercise those stock options. So let's talk about how we account for treasury stock. So of course we're going to be paying for this stock, but treasury stock is not an asset of the corporation. When you hold your own stock, it is not an asset. So treasury stock does have a debit balance, but it's actually a contra equity account. So it's going to be shown in the Stockholders Equity section as a subtraction from after retained earnings. So it reduces stockholders' equity. And we don't pay any attention to the par value using the cost method. So we will strictly, you'll see when we do the journal entries that we're going to record treasury stock at cost or at the amount that we originally paid for it. So let's look at the journal entry for Smart Touch Learning when they purchased 1,000 shares of their previously issued common stock and they paid $5 per share. So we take $5 and we multiply it by 1,000 and we get $5,000. So we debit treasury stock common for 5,000 and we credit cash for 5,000. Now let's say that Smart Touch Learning later decides they want to sell 100 of those 1,000 shares that they purchased on April 1st for $5 each. So they resell 100 shares of treasury stock at the same price that they originally bought it, which was $5. If they do that, they debit cash for $500, which is 100 times $5, and they credit treasury stock common for the same amount. And the T account shows then that the balance in treasury stock after that entry is $4,500. Now let's say that they resell another 200 shares of that 1,000 shares, but this time they sell it for $6 a share. So this is $1 more than they originally paid for it. Okay, so they paid $5 per share to start with. So we would debit cash for the amount of the proceeds, which is $6 per share times 200 shares. And then we would credit Treasury stock, but we credit Treasury stock for the original cost. So the original cost was $5 per share. We multiply it by 200 and we credit Treasury stock common for $1,000. Now the difference between the amount of cash, $1,200, and the credit to Treasury stock is going to be credited to paid in capital from Treasury stock transactions, and that amount is $200. So the shares sold for $1 more than they were originally purchased for, so $1 times 200 shares. Now it's important to note we never record gains on the sale of our own stock. When we are dealing in our own stock, we do not record gains or income. So the difference when we sell it above cost is going to be credited to paid in capital Treasury stock. Now let's say that we sell an additional 200 of those Treasury shares, but this time we sell them for $4.30 per share. So this is actually going to be 70 cents less per share than we originally paid for it. So in this case, we're going to debit cash for $4.30 per share times 200 shares, or $860. We're still going to credit Treasury stock for the amount of that the shares originally cost. So they cost $5 per share. So $5 per share times 200 shares is $1,000. The difference between the original cost, $5, and what we received, $4.30, or 70 cents per share, times the 200 shares, or $140, is going to be debited to that paid in capital from Treasury stock transactions account. So the rule is that when you sell Treasury shares for less than their cost, the difference will be debited to paid in capital from Treasury stock transactions, as long as there is enough in that account to cover the difference. So we originally had recorded $200 on April 2nd as a credit to the paid in capital from Treasury stock transactions. So we had enough in that account to debit it for the entire $140, and we have a $60 balance remaining. Now we're going to look at another entry where we sell the shares for less than cost. So the next transaction on April 4th, we sell 200 additional shares of Treasury stock for $4.50 each. So again, 50 cents less than we originally purchased them for. So in this case, we're going to debit cash again for the amount of the proceeds, which is $4.50 times 200 shares, or $900. We're still going to credit Treasury stock for the original cost of $5 per share times 200 shares, or $1,000. Now the difference of $100, which was the 50 cents times 200 shares, we're going to debit first to paid in capital from Treasury stock transactions to the extent that we still have a balance in that account. And if you remember, we only had $60 left. So we debit it for the $60. That reduces that account to zero. The additional amount of $40 would have to come from retained earnings. So that is the rule. When you sell Treasury shares below cost, you debit paid in capital Treasury stock transactions, but you cannot reduce that account below zero. So any additional amount would have to come from retained earnings. Now let's look at stockholders' equity after these Treasury stock transactions. So we can see that Treasury stock is shown in stockholders' equity as a contra equity account. So below retained earnings, we see Treasury stock with a negative 1,500. So that's the remaining shares that we had left of 300 shares at $5 per share. So that amount reduces stockholders' equity. Now, how did this work out, or how can we look at how these Treasury stock transactions affected outstanding shares? Well, we know from the earlier presentations that Smart Touch Learning had 20 million shares authorized. So over its entire lifetime, it can issue 20 million shares. They had issued 23,000 shares, so they have a large amount unissued. Out of the issued shares, right now they have 22,700 shares outstanding, and they have 300 shares in Treasury. So we can see that there is a difference between issued and outstanding shares. And the reason that it's important to distinguish between issued and outstanding is we're going to find out that only outstanding shares receive dividends. Treasury stock does not receive dividends, and we'll see that later on. Now, sometimes corporations do buy back their shares and want to retire them, so they're not going to reissue them. They're not going to be kept in Treasury. Retired stock, these certificates will actually be canceled, so they can't be reissued. When we repurchase our shares for retirement, we are actually going to debit the actual stock account, so common stock and any additional paid-in capital that we received when we issued those shares, and then we would credit cash. And these will be permanently retired, so just removed. And lots of times retirements of preferred stock happen because the company doesn't want to continue to pay the preferred dividend. So retirements of preferred stock are probably more common than retirements of common shares. And that is the conclusion of the presentation for Learning Objective 13.3.